Hi guys, welcome back. Today we're going to talk about Chapter 14, Financial Statement Analysis. So this is a chapter, kind of useful chapter in my opinion, on going through and understanding a company's financial statement, being able to look at really any financial statement and do some analysis on it. It's a skill that you'll need to use as a manager, also potentially as an investor as you go through. If you're looking at companies you want to invest in, whether that's money or debt, if you're working on a bank or some sort of lending company. So it's a good skill to have. So we'll go through it. So our first learning objective here is we're going to perform a horizontal analysis of financial statements. So a horizontal analysis provides a year-to-year comparison of a company's performance in different periods. So these are just a couple of different ways we can analyze a company's financial statements. So whether we're going to look at it from a year-to-year basis to see how we're doing over time, maybe it's the same account, see how our sales trends are going. Just do a comparison, see how 2015 stacks up to 16 versus 2017, so on and so forth. So we have that horizontal analysis. We also have vertical analysis, which means we go through and evaluate the relative size of each line item in the financial statements. It's helpful. We can compare different companies at different sizes. So it sometimes can be hard to compare a company that has $1 million of sales compared to a company that has $100 million of sales. It's hard to kind of look at and grasp the numbers. So what we would do with that is kind of, rather than looking at the dollars, the numbers, we'll look at by the relative percentages. Because if we break it down to percentages, we can see how much is payroll between the two companies. Is it 5% of one company, 30% of another company? So it allows us to kind of look at, rather than just the whole numbers. If you've ever gone on to like the SEC website, it's hard to kind of lose track, or it's easy, excuse me, to lose track of comparing like a Microsoft, which has, billions and billions of dollars of assets and revenues every year. It's hard to compare that to really anything else, especially if we're looking at more privately held businesses. So we, rather than looking at the dollars, again, we look at percentages. We can also do this on an individual company basis, right? So rather than looking at the sales expense, the depreciation expense, the cost of goods sold, we can simply look at the percentage of generally sales. So what percentage of this line item? What percentage is this line item of the total sales of the business? So how much of all the money coming in goes out to this particular line item? And then the last thing we'll look at is ratio analysis, which will look at some of the key ratios that you should know when you're analyzing a business. So we have our income statement here. And we have a Supermart income statement, and we have our 2017 and 2016 numbers year to year. So we have our comparison, sales revenue, we have cost of goods sold, gross profit, operating expenses, interest income, income before income taxes, then income tax expense, then down to net income. So we can just go here and this is a common thing if you guys have ever been on a company, if you've ever been on a board of a company. Nonprofits generally look for professionals to be on the board. If you've ever had another assignment where you're looking at just two numbers, two different years of the same business, this is a common setup where there's kind of things side by side. And so we're going to look at how can we dive a little deeper into just saying sales went from 803 to 858. We also have the balance sheet information. So we have total assets, total liabilities, and then total stockholders' equity of the Supermart balance sheet of the Supermart company. We have the 2 years side by side. So that's basically our setup for the information here. Is we want to have our 2 years of comparative data, or however many years of comparative data. So now that we have that information, we can do a horizontal analysis. And we really need the 2 years at the minimum to do a horizontal analysis, because we need to compare it. If you think about the word horizontal, it's going left to right, going across a straight line. So we study of percentage changes in comparative statements. So it's a two-step process. Step one, we compute the dollar change amount of the period from the earlier period to the later period. And then we divide that change by the earlier period. So we're going to do a calculation. We come up with basically the base year, which is going to be the earlier year. And then we compare it. We find the change. So 2016 to 2017. Did it go up or did it go down? So we find that change. Earlier year minus later year. And and we find that change. And did we go up or did we go down? So we have here, compute the dollar amount of change in sales from revenue from 2016 to 2017. So the way we're setting this up is you take the further, the farther away year. So 2016 is our base year. So we're going to compare everything to 2016. So were we above or were we below our base year? So in 2017, we had $858,000 of revenue. 2016, $803,000. So we had an increase there of 55%. So we compare, we have the year we're trying to compare minus that base year, because that base year is what's going to tell us were we above or below that base. So we had a $55,000 increase, and then step 2 is to divide the dollar amount of the change by the base period amount. So dollar amount of the change, 55,000, divided by 803,000. So we have 0.068. To make that a percentage, we multiply it by 100. So we have a 6.8% increase. And again, it's positive here, so it's an increase. So it's a 6.8% increase. So that's what we're doing. We're doing a horizontal analysis. We're taking our base year, which if you start thinking about a business over time, we got to start with the base year. What happened? So we look at, for this company, our supermarket company, we're looking at 2016 as kind of the base. That's just what we're comparing it to. So there's no right or wrong, really. We just want to pick a base year. Maybe if you go through, and if you're familiar with the business, 2016 was the first year that we had the new store open. So that's going to be our base year. Maybe over time, as if you opened up another store or you closed the store, you might come up with a new base year when the normal changed. But you come up with your base year, and you compare all your subsequent years to that. So you can see over time we were 6.8%. Maybe 2018 we had $900,000 of sales. Maybe 2019 we dipped down to $750,000 of sales. But you compare it to the base, that way everything is relative. So we're 6.8, we're 10%, we're negative 5%. So we always want to compare to that base so we can kind of keep everything relative, as opposed to just doing every year the difference in the 2 years, because over time we're going to lose sight of that change. If we're comparing different, we're not comparing apples to apples anymore. If we start changing the years we're looking at for the percentages, we're going to be comparing apples to oranges and apples to kiwis and apples to mangoes or something like that. So we want to pick a base year that we can compare all other years to, so we can have that relative change. So we have here on our income statement, we could go through and we can just grab our change, our increase or decrease, and we can see here over time for 2016 compared to 2017, everything has gone up. So our revenues increased, our cost of goods sold increased, our operating expenses went up, everything has gone up. We had a better year over time, and most importantly, we can see that our top line revenue, 6.8% increase, resulted in a bottom line net income increase of $22,000 or 84.6%. So we can have, a small top line increase resulted in a significant bottom line increase, but we can also see on the flip side, the increase there increased significantly our income taxes as well. So yes, we made more money, but we also owe more in expenses, which is generally true in business. As you make more money, you owe more in taxes, you owe more in expenses, because you have to spend money to make money. But hopefully, as we can see here, the significant, increase in our bottom line was a result of only, relatively only a small increase, 6.8% increase in our top line revenue. So, probably we're at the point where, for the supermarket company, we've kind of, and if we've talked about, over the past chapters, we've talked about fixed versus variable. So with this type of company, a small increase in revenue, $55,000, which again was only a 6.8% increase, that most of that resulted right to our bottom line getting bigger. So 55,000 increase, 22,000 of that went right to the bottom line, right to the owner. So what does that tell you for this company? Probably that most of the expenses are fixed expense, or a majority of our expenses are fixed, and we've probably already gotten to that point where we've already paid for most of those fixed expenses. So any additional increase to our bottom line is going to go right down to our net income, or a good percentage of it. $55,000 increase in sales, 22,000 of that 55. So roughly, if you think about 40% of the bottom line, or 40% of the income increase went right to the bottom line, right to the owners of the business, which that's a good thing. That's a good thing, especially when you consider looking at the base year, we had 803,000, and only $26,000 of that went to the bottom line. So that not a great percentage. So 26,000 divided by 803, and this is really kind of going into that vertical analysis. So I'm jumping ahead a little bit, but I just want to make that point. So 2016, that base year, only about 3% of our revenue was going to the bottom line. And then we can see that change. 22,000 of the next 55 went to the bottom line. So that would be, about, like I said, 40%, exactly 40%. So we can see now at that point we've paid for most of our fixed expenses. So any increase really over the 803, over that base year, we're going to see a large amount of that going right to our bottom line. So kind of skipping ahead in our analysis, going to kind of the vertical analysis, but we can see here, just by doing a very, very simple horizontal analysis, and just taking a look at the numbers and kind of thinking outside the box a little bit, kind of not just doing the percentages and 6.8%, 0.08%, all that, actually trying to understand what they're actually telling us. And just a quick 2-minute analysis there, we can see that probably this company has a lot of fixed expenses, and they've already been paid for under $803,000. After this, a majority of or a good portion of their increase in sales is going to flow right down to the owners of the supermarket. So, that's good. That'd be a good analysis you can give to the owners of that company. We can see the horizontal analysis on the balance sheet. We go the same way. We look at 2016 as our base, and we compare that to what happened in 2017. So we have our increases and decreases, and then we find our percentage changes. So we can see here we had the better year bottom line wise, but our cash actually went down. However, our accounts receivable are significantly up. So a balance sheet is kind of hard to do sort of a trend analysis on, because it could be just when we're looking at this, just over time, it could just be that the cash on January 1st, 2018, all that accounts receivable turned into cash. So it's kind of hard, because remember, a balance sheet is just a snapshot of the company's outlook on that particular day. So within a day, 2 days, this could significantly change. So it's kind of hard to do more of an analysis. You have to do a little bit more digging into understanding that. But you can see the same horizontal analysis. Probably where this is more useful is just looking at the overall current assets. So rather than looking at the individual items there, we can see overall the current assets. So those liquid assets that we're going to be paying off our current liabilities, our current bills, those are up about $26,000 or 11%. The other thing we can look at from the horizontal analysis of the balance sheet, where is our investments going? Where are our improvements to the company? Where are those coming from, and how are we paying for them? Because we can see here, our real big change on our balance sheet is our property, plant, and equipment. We significantly made some investments this year, $108,000. And if we go down to the liability section, that matches up perfectly to our long-term liabilities. So apparently we bought some new assets, maybe bought some new equipment, maybe bought a new building, and we can see we paid for that through our long-term liabilities. We bought a new piece of equipment, and we took it out, financed it from the bank. The bank gave us the money to pay for it. So I always, the balance sheet, while it's hard to do some trend analysis, it does tell the story of where the business went in the past year. Even though it's just a snapshot of the day, if you look at the kind of those long-term accounts, the notes payable, the property, plant, and equipment, and the stockholders' equity, those will generally tell you the story of what happened for the year. So here we have our stockholders' equity went up, And if we go back to our income statement, that's because we had net income. Makes sense. We have our long-term liabilities went up, and our notes payable went up about, what's that, 106,000. And look at that, our property, plant, and equipment went up 108,000. So the company is investing in itself, and at least in the short term right now, it's paying off. Our sales increased 55,000 with an increase of assets of about 108,000. So I would say that's a pretty good trade-off. We've already almost paid for our investment. Obviously, we're financing it, so we're going to pay it off to the bank over time. But that kind of risk, that investment in the company, appears to already be paying off. Some of the other things you can tell, like I was saying, from your current assets and our current liabilities. So even though we've increased our revenue, 6%, about or close to 7% from our income statement, we can see that we didn't have to buy significantly more inventory. So we're still turning over our inventory enough. That's one of the important ratios, and we're going to get to that in a minute. Are we investing a lot in our inventory? Are our accounts payable, are those significantly increasing? If your inventory, generally, if you're a retailer, if your inventory is not increasing, I would anticipate your accounts payable increasing. But really, it's the balance sheet. If you really, really look at it, it tells a lot of stories. If I was going back to my public accounting days, the accounts receivable increasing 29%, or 29,000, or 35% roughly, we'd be having a conversation with the owner of this company or the managers of this company of, okay, what's going on here? Why is our accounts receivable increasing significantly? You'd want to look at the age of them. Is that all accounts receivable for the month of December, or are some of those aging out? Are people not paying us from November, from October? So that could be the reason why our cash isn't as high as we thought it would be, because it's just all of those sales revenues are still sitting in. We're still waiting for it to get paid from our customers. So the balance sheet tells us a lot of stories. I could sit here probably for another 3 or 4 hours just talking about the balance sheet of this one particular supermarket company. And a lot of, if you get familiar with the balance sheet, you can tell the story. You can almost guess, or you can almost hypothetically come up with what the income statement would have looked like just based off of these changes. It's not going to give you all the answers, but you can kind of figure out what's going on with the business. The balance sheet tells the story of what's going on in the business, and then the income statement, and then questions to the owner or to the manager or the decision makers can kind of fill in the rest. Because you don't want to just jump to conclusions that they're having an accounts receivable problem, they have a cash problem. It could just be that a big customer came in and made a big order in the month of December, and then they paid you in January, and it's just a timing thing, because that cutoff can kind of play tricks on the balance sheet. But the big thing here is we can see they're investing in the company, and they're doing that through business financing, money from the bank. The other thing you want to keep in mind that I always tried to point out to staff accountants when I was working in public accounting, is just you want to look at your trends, your percentages, and you just don't want to spend too much time on big changes for small dollar amounts. We always try to look at percentage and dollar changes, because we can see here on this balance sheet. So our balance sheet total assets are about 787,000, and then for 16 it was 644,000. So if you look at your other non-current assets, the percentage-wise they've increased 100%. They've doubled, but that was only for $9,000. So probably wouldn't spend a lot. Maybe just a quick question of what's going on there. Why did that change? But that's it. I'm not going to spend a lot of my time and a lot of my energy trying to track down $9,000 on a $787,000 balance sheet. So I digress, though. We continue here. So we look at our trend percentages. That's our next form of horizontal analysis. And this just indicates the direction a business is taking over a longer period of time. So again, we select a base year, set the base year equal to 100%. So that's we're looking at 2016 for our supermarket company. And as we go over 5-10 years over time, we're going to look back at all our changes. So 17, 18, 19, 20, 21, 22, 23. We're looking at all those years, and we're going to compare it back to that 2016 base year. And we're going to just track how we're doing over a long period of time. So we're going to set the base year to 100%, and then each of the following years expresses a percentage of that base amount. So our trend percentage is any year's dollar in sales or expenses, whatever we're looking at for the trend, divided by the base year. So if we're looking at sales, what was our 2017 sales divided by 2016? If it's greater than the 2016, it's going to be at a percentage greater than 100. If it's less, it's going to be at a percentage less than 100. We're actually going to be able to see that trend. So we have here, so assume supermarket selected in 2012 as the base year, and its sales trends are as follows. So we have 2012 as our base year, and then for 13, 14, 15, 16, and 17, in theory, we would take all of those numbers and to come up with the percentages, we would have divided it by 600,000. So the first thing you can see that all of our years are greater than 600,000. So for one, all of our trends are going to be at 100% or more. So 13 was slightly over our base year, so we have just 103%. But then as we go up, 648,014, we're getting higher above our base year, so it's a higher percentage. And then as we really get to 17, we're significantly higher. We're almost at roughly 50% more than our base year. 600,000, 50% would be 300,000. So we're almost there at 858,000, and we're at 143%. So we're going to see over time when we graph this out, we're going to see over time that we're going to have kind of a sloping upward scale, which is what we probably want to see. Over time, at some point, they're probably going to want to change the base year because, as we saw on our balance sheet, especially for 17, they made some significant investments in the business. So at some point, the 2016 number is almost going to be like we're running a completely different business. So we might need to change that base year out so we compare it to more accurate. So we can see over time here, we have the trend, and from 12, 13, 14, 15, we're kind of slowly creeping up there. And then 15 to 16, and then 16 to 17. So in that 2-year period, we had a pretty suddenly that slope increased significantly there, and probably going forward we're going to see that again because we are making some big investments that we saw on the balance sheet for our supermarket company. But graphing over time, over time we're going to see hopefully see a nice steady increase, and then when we graph it out, we're going to see. If we see significant spikes or drops one way or the other, we could investigate what's going on that year. Increases, maybe the market changed, maybe a competitor went out of business. With our supermarket company, we're deducing that that they made some significant investments in the company in 2015, 16, 17 years, and so that paid off with an increase in the revenues. Excuse me. But the graphing and doing the trend over time, we can really see when the changes of the business are. We can try to go back and pinpoint, all right, what happened? What caused this spike? What caused this spike? So obviously, if it's a increase, we may want to try to replicate that. If it's a decrease, we can see what do we need to avoid, or maybe what's some of the warning signs we need to be on the lookout for. So next, we're going to perform a vertical analysis of the financial statements. And so horizontal, we went across, and that's generally over time. Vertical, we're going to compare the different line items on our financial statement to a base account. So again, we show the relative of each item to a base amount, 100% figure. So generally on the income statement, it's going to be sales. On the balance sheet, it might be total assets or total liabilities or total equity. We just see what is the breakdown of the whole number, and that's the sales revenue or the total assets. Because if we think about on the income statement, we start off with our sales, and that's 100% of everything coming in the door, and then we're going to break it down vertically into, for every dollar of revenue, basically, so every one additional dollar of sales we bring in, 30 cents goes here, 10 cents goes there, 1 cent goes here, 4 cents goes there. We can see exactly where all of our money is being spent, and when we get to our net income, what percentage of that additional dollar is going to go right down to the company's owner. Balance sheet, we can look at the breakdown of the total assets, or if we're looking at liabilities and equity, total liabilities and equity, just to see the percentage of kind of our assets and debts, what is each line item compared to those. So we start here with our income statement, our vertical analysis. And again, for any of these things, if you're doing it in Excel, very, very straightforward, and this is what they've done here, it's very straightforward. You can write a formula in the C column to just equals sales revenue divided by sales revenue. So equals B6 divided by B6, and then you can just basically almost copy that down. So our formula is always referencing back to our B6 as our denominator, and then our numerator is going to be the individual line items in our vertical analysis. So we would do cost of goods sold divided by sales revenue, gross profit divided by sales revenue, operating expenses divided by sales revenue, operating income divided by sales revenue. And we can just see what the breakdown is. So again, for every dollar of sales revenue, 59 cents or 60 cents would be going to our cost of goods sold, leaving us 40% left over for our gross profit. Then we'd have 28 cents would go to operating expenses. So we'd have operating income of about 12 cents for every dollar we sell. Then we have some interest expense, 3 cents or 4 cents rounding up of income taxes. And so we can see for the 2017 year, for every $1 of revenue, about 5, call it 6 cents would go right to the bottom line. The other 94 cents were going to pay for the expenses of running our business. So that just gives you an idea of what's going on for every individual sales dollar coming in the door. So it's a good breakdown. And what you can do with this, now that you have percentages, rather than worrying about revenues and dollars, you can compare these to other businesses and other companies. Or if you have multiple supermarkets, they could actually do this for every one of their supermarkets. And maybe their supermarket in New Bedford doesn't have as much sales as their supermarket in Providence, but when they look at the percentages, they can kind of compare apples to apples. So rather than looking at, this cost of goods sold or this sales is $2 million compared to they're doing worse because their sales are only $858,000. When they look at the percentages, that's going to kind of even the playing field. So you can kind of compare apples to apples, especially when you start talking about some of your expenses. Cost of goods sold, obviously that's going to go up if your sales are going up. So, but at what percentage, or what's our gross profit for every different location? We can do the same for our balance sheet. We can compare what each line item is as a percentage of our total assets and our total liabilities and equity. So we can just see the breakdown of where is our money being spent and where do we owe our money from our debts, from our total liabilities, or is it due to our stockholders at some point in the near future? And what's nice about our vertical analysis, as we see here, we can do benchmarking and then common size statements where we just simply can compare, rather than compare dollar for dollar, we're going to compare as a percentage. So with benchmarking, we can compare a company against either competitors or the industry average. Most industries that we operate in, there's a lot of different vendors and a lot of different service agencies that will actually give you industry-wide data, so you can compare supermarkets in the Northeast region to your business. So usually it's a paid subscription, or you can go online and get some. Generally might be a little less reliable, but you can get the information from industry data for your country, generally for your region, broken down pretty, going down to a pretty micro level. And you can get information, or if you have competitors, or like I was saying, if you have different locations of the same business, not necessarily like competitors, but you can see location 1 versus location 2. When you benchmark, you can compare it to an industry or a competitor average. You then have the common size statement as well, and that's used to compare companies to each other. And if you don't want to show your numbers, you don't want to show here's my sales dollars, especially if it's a competitor or you're giving out information. We can show percentages and we can compare those. We don't necessarily know how much revenue we have, but if we're in the same industry, we can compare the percentage. So what percentage of every of our sales is going to cost of goods sold? Are we spending significantly more on our cost of goods sold or less on our cost of goods sold? And you can break down from your line items and you can compare where are we losing money, where are we gaining money compared to either a competitor or the average. And like I said, when we're looking at percentages, that kind of takes away oh, this is a $10 million company versus this is a $100 million company versus this is a $500,000 company. When you're looking only at percentages, it makes kind of everything very or easier to compare apples to apples. It's not always going to hold true because obviously in the business world you do have some economies of scale, so it might throw off some of your percentages and some of your ratios. But that's it's a good kind of discussion to have. Oh, with our $100 million supermarket company compared to our $500,000 supermarket company, you might have some more infrastructure costs on the bigger company, but probably you have more buying power, so probably some of your percentages are going to be better. So you can do that and try to see where you can gain advantages or where you're missing out, and try to do some analysis, see what you can do better, see what kind of is out of your hands. So we have here, we have our common size income statement, and again, we don't show our income numbers, our sales revenue numbers, or our cost of goods sold numbers. We simply have our percentages. So we have our supermarket and Target. So I don't know if this is actually like Target brands, or maybe just the Target company, but let's assume it's Target brand. So again, sales revenue always going to be 100%. But we can see right from the start here, our cost of goods sold and our gross profit, our company, that has a significant advantage, a significant difference in our gross profit. We're up about 10 percentage points. So for every dollar, our company is keeping 10 extra cents that is going out the door for Target. Operating income, we have a higher percentage there than Target does. So it kind of evens out back to our operating income is almost on the same level again. And then once we get down to our interest expense, 2.3% compared to 0.08%. It's almost kind of getting back down to zero. We're paying a higher percentage of income tax as a total percentage of our sales revenue than the Target company here. And so when we get to our bottom line, even though we had the significant increase in the gross profit or significant advantage, when we get to the bottom line, net income for every dollar we have, 5.6 cents is staying home, whereas for the Target, for every dollar they have, 4.5% is staying home. So at the bottom line, at the end of the day, we're kind of on the same playing field, and let's assume that it is Target. Obviously, compared to our supermarket store, which had about $900,000 of sales, Target, publicly traded company, billions of dollars of sales. That 4.5%, 4.5 cents for every dollar, obviously, as we scale that up to $1 billion compared to 5.6 cents for every dollar of 900,000, they're going to pass us along the way very, very quickly. Probably in a day or two, that's going to be past our supermarket net income for the entire year. But we can see there, if we're just comparing it based on the percentages, we can kind of get some information and kind of get everything on the same level playing field. They're spending more money here versus we're spending more money there. So next we're going to go through for our learning objective number 4 and compute some of the standard financial ratios. So some of the common financial ratios, measuring the ability to pay the current liabilities, measuring the ability to sell inventory and collect receivables, measuring the ability to pay long-term debt, measuring our profitability, and then analyzing our stock investments. So the first 4, 1, 2, 3, 4, the first 4 there, very important. Every business should really understand that. The stock investments, it's good. We're going to go through them. But depending on what type of business you are, if you're a privately held business where you're the owner of your business, you're not as concerned about as much as that. If you're a publicly traded company with a lot of investors, you might be a little bit more concerned. So let's go through some of these. So measuring the ability to pay our current liabilities. So we're going to look at our working capital, our current ratio, and our asset test ratio. So this is really, and when you get into the business world, if you start looking for money from investors or more importantly, money from the banks, these are some of the important ones, the important calculations, the important ratios you want to understand. Because as someone who's going to be lending you money, one of the first things they're going to be concerned about is if we're going to give you more money, let's first see, do you have the ability to pay off the money you currently owe, right? If you can't pay your current bills, why are we going to give you more monies that you won't be able to pay back? So the first calculation, it's our working capital, and it's basically our current assets subtracted from our current liabilities. And one of the things you might want to do is go back to the slides and get the balance sheet and the income statement for our supermarket company. Maybe just print them out or write down those figures so you can kind of go through and see where those numbers are coming from. So for 2017, if you look back, we had current assets of 262, and remember our current assets are those items on our income statement that within the next 12 months, we're going to liquidate those and turn those back into cash. So, in any business, cash is king. We want to have to pay our bills. We have to pay our employees. We have to pay our owners. We have to pay them all in cash. For the most part, a company or an employee won't be happy as if you say, instead of giving you a paycheck this week, I'm going to give you, if it's a supermarket company, I'm going to give you a turkey. They want cash because they need to pay their own bills, right? You're an employee. For someone, you need to pay your bills by working and putting in your hours at the business. You don't want to just get the inventory of that company because your landlord or your bank isn't probably going to accept a big turkey in the form of payment for your mortgage or your monthly rent. So, anyways, I digress. So we have our current assets minus our current liabilities. So this is how much working capital. How much funds do we have to kind of operate our business? Think about it that way. That's kind of our operating cash flow. So here, 262 minus 142. So we have $120,000 of kind of freed up capital to pay for our current obligations to run our business with. And obviously over time, every week or every day as we go through, we're going to bring in more money from our customers. We're going to pay out more bills to our vendors. So this is obviously it's a moving target. But this tells you on any particular day kind of how much cash is available to work and to meet future obligations. So for this, they have ample current assets to meet the current obligations of the business, plus they have some surplus to pay for any additional ventures they want to go on. So for this, really, kind of always the golden rule when we're talking about these current ratios is you want to have more current assets to current liability. So the closer to zero you get, the riskier kind of you are from an outside observer. And then if you're at negative, that's a red flag. If you can't pay your current bills, how are you going to pay any sort of future bills, or how are you going to take on more risk or more investments, etc., going forward? So you always want to have a positive number here. And then obviously, relative to the size of your company, $120,000 on, if I remember, the balance sheet in total was about 800,000. You can tell me if I'm wrong or right looking back at your numbers. But that's a pretty good sample, or a pretty good kind of cushion to have for the current, to meet the current obligations. Next formula, current ratio, and this is one that everyone absolutely should know. So it's our current assets divided by our current liabilities. So again, it's digging in more, and we have three here, and when we get to the acid test ratio, but we have three formulas, three ratios that deal directly with, can we pay our current obligations, and do we have some leftover monies for future current ventures and current investments. So current ratio of 1.5 to 2 is generally strong. So supermarkets current ratios, if we go back, 262 for 2017, 262,000 divided by 142,000, we got 1.85. For 2016, it was 236 divided by 126, so it was 1.87. So again, we want to have a ratio of 1 or better, and the higher up 1.5 to 2 is generally very strong. And what that's saying is we can pay all of our current liabilities off with what we have available in current assets. So we can pay all of our bills, that are due as of today. We're going to be able to be just fine. The higher that number, obviously, the better. If you're at 1, a current ratio of 1 to 1, so your current assets equals your current liabilities, it's not a great sign. And again, if that number is below 1, so 0.9, 0.8, again, that's not a good sign. You're going to have bills that, if every vendor came and said, you have to pay me right now, someone would be coming up short for some of those bills. So that's not a great sign for your business. So you want to be above 1, and then 1.5 to 2 is really, really good. Anything really above 2 is just fantastic. Asset test ratio. So this is similar to our current ratio, but we don't look at all of our current assets. It's just our cash plus our short-term investments, plus our net current receivables divided by our current liability. So we're taking out our inventory, we're taking out our any prepaid expenses, and it's our net current receivables. So if we have a guy who owes us $10,000 from 3 months ago, we take that out as well. It's really the acid test ratio is really everything that's almost the same as cash, right? So your investments in inventory, we have to wait for another customer to walk in the door. So if nothing else came in, if our business closed that day, in theory, we'd have to do something else with that inventory. So we take that out. So our current investments, we could very quickly liquidate. Obviously, our cash is already in cash, and our net current receivables, those should just, within a couple of days turn into a cash as well. So this tells us whether the entity could pay all of its current liabilities if they became due immediately. So this is, if you've ever seen It's a Wonderful Life, everyone rushes to the bank to get out their money. It's starting to get towards the Great Depression there in that movie. Everyone goes to the bank and they say we can't give everyone their money back. So this is kind of what that kind of acid test ratio is. If all your vendors came in right now and said we need to pay our bill right now immediately, what is available that we can liquidate basically immediately to turn into cash? So again, we don't include prepaid expenses and we don't include our inventory because for those two items, current prepaid expenses, it's like when you pay your 12 months of your automobile insurance. You paid it, you get your insurance, but from an asset standpoint, you can't go and be like, all right, well I can't pay my bill today, but take a month of my insurance. Like that's not a thing. And the same thing with our inventory. We need a customer to come in to buy our inventory to turn that back into cash. It's not really something we have control over necessarily. So because we're taking away some of our, especially if you're in the retail business, some of our significant current assets, we don't have the same standards as say the current ratio where we want to be greater than 1 and probably closer to 2 to be real comfortable. So because we're taking away some of our potentially we're taking away or we're excluding some of our significant assets, especially current assets, i.e. inventory. So we have here a 0.9 to 1 is acceptable in most industries. So for the supermart's acid test ratio, for 17 we're at 1.1, and for 16 we're at 0.93. So both, 17 we're above that acceptable standard, and then 0.93 we're kind of right in the middle of that acceptable standard. Again, this is a hypothetical situation because generally in your business world, not all of your vendors are going to immediately demand payment, and probably the current ratio is more accurate because you're going to turn your inventory over. Especially if you think about a grocery store, they better be turning their inventory over, every 2 weeks or every 3 weeks. Otherwise, what happens to inventory at a grocery store if it sits on the shelves for 2-3 weeks? Most of it's going to have to get thrown away. So hopefully they're turning it over quicker than that. So that's probably more accurate and one that's more commonly used. But the acid test ratio is kind of like, worst case scenario that we're talking about. Can we pay all of our current debts with just what we have almost available basically in our checkbook? So next we have, again, as we were just talking about, some of these turnover ratios, and these are some great ratios to really understand the business. And basically we're looking at how quickly, if we're talking about the inventory management, accounts receivable, the business cycle, how quickly we turn our investment in inventory into sales and then, turn those sales into cash. Because that's, again, cash is king, and that's what, when we're talking about all these ratios and trying to understand, that's really what we're getting to is how much cash do we have with the current in the asset test. That's really, kind of what you're trying to get at. Can you pay all your bills with the cash you have now or the things that are going to quickly turn into cash? And then our next set of ratios here, how quickly in the business cycle are we turning our initial investment in inventory? How long before we turn that into cash back in our pockets? How quickly do we make that return on that initial investment? So inventory turnover ratio equals cost of goods sold divided by our average inventory. And for that, we basically need 2 years of inventory to get our average. So you just do basically a simple average, beginning plus ending divided by 2. Get a simple average. And it measures the number of times per year the company sells its average level of inventory. So higher turnover indicates ease of selling inventory. Low levels indicate difficulty. So the supermarket's inventory turnover ratio for 2017 was $513,000 of inventory, or of cost of goods sold, divided by their average inventory, which 112,000, 111 plus 113 divided by 2, 112. So that means they turned over their inventory 4.6 times every year. So if you take that the next step, if you divide that number, if you divide 12 by that number, so 4.6, so 12 divided by 4.6 means that every roughly 2.6 months that they completely sell all their inventory and restock it with all new stuff. So altogether, it's about once a quarter, 4 times a year, about once a quarter, a little more than once a quarter, we completely our store has completely new inventory. And obviously for a supermarket, everything about if you go into the supermarket, some of those items, yeah, they could sit there for a month or two. If you think about the paper products or some of the other items, yeah, at the grocery store. So a company like this, they would most likely have a breakdown of probably the department. What's their deli inventory turnover? Because if your deli inventory turnover is 4.6 times, once a quarter you turn over all your deli meats. Customers probably aren't going to be too happy with the freshness of their turkey sandwiches they're making at home. But it's a great ratio. It's a great one to understand in a business. How many times are you turning it over? And it's an easy one to kind of look at the dark side of business. If all of a sudden their inventory turnover ratio goes up from, if it's traditionally around 4 or 5, and then 1 year it goes to 39, probably something's going on hinky with those numbers. They're inflating some numbers there. At the same time, if you're turning over your ratio once or twice a month, so your current ratio, or your inventory turnover ratio is 12 or 16, turning it over once a month or a little bit more than once a month, and then all of a sudden it goes down to 1 or 2, either something went terribly wrong with their business that year, or again, something's going kind of funky with their numbers. Accounts receivable turnover, that's your net credit sales divided by your average net operating or net accounts receivable. So again, it measures the ability to collect cash from your credit customers. So again, higher ratio indicates faster collection. So if we look here, we have apparently all of our sales are on accounts receivable because we want to do our net credit sales, not just our net sales. If it's a cash sale, there's no waiting. If you come in and pay cash, the business has your cash. So it's just your net credit sales divided by your average accounts receivable. So 85,000, which was our accounts receivable in 2016, plus 114, which was our accounts receivable in 2017, divided by 2. So we turn over our accounts receivable 8.6 times a year. So again, if we take 12 divided by 8.6, that tells us about once every, it's 1.27. So once every 5 weeks, roughly, we're getting a sale turns into cash. So that tells us if someone pays for or comes in and buys for something on April 1st, we're going to see that cash on average by the first week of May, roughly, about 5 weeks, 1.27 months. So that's the, if we put those two together, if we go back for a second here, our inventory, we're going to turn over. So we buy our inventory, and then we said about 2 months down the road, or 2.5 months down the road, we sell the inventory, right? So if we buy it on January 1st, we're going to sell it down the road about 2.5 months, because that's how quickly we turn over our inventory. So we're going to sell it 2.5 months or whatever that number was down the road. So if we buy it in January, we're going to sell it sometime in the middle of March, and then it takes about 5 weeks to collect cash. So when we put that together there, if we make the sale in March, maybe at end of April is when we actually get that cash. So we can see there it's 5 weeks or a month plus 2 months. So about 3 months we go from buying the inventory into getting that investment back into our bank account. So this really helps someone understand the accounting cycle of how quickly an investment in inventory, because that's all inventory is for a business. It's an investment in themselves, right? A company buys inventory, to sell it at a markup, and that's how they make their money if they're a retailer. So if they buy something in January, they're going to get that return on the investment in cash in about 3 months or 3.5 months down the road. So again, our days sales and accounts receivable. So 1 day sales equals our net sales divided by 365. So days sales and accounts receivable equals our average net accounts receivable divided by 1 day sales. So this is basically what I was just saying when we divide that AR turnover, 12 months divided by our AR turnover gave us 1.27 days. This is another way of solving it. So 42 days, which is about 1.27 months, about the same, 40 weeks. So in this strategy of getting to the days sales and accounts receivable, we take our total net sales divided by 365. So $858,000, that was our net sales, divided by 365 days. So every day, our sales are 2,351. We then take our average accounts receivable, which is again was the 85,000 plus the 114, divide that by 2, divided by that days sales, 2,351, and that tells us 42 days. That's how many days it takes us to turn over our accounts receivable, which was the same way, if we took our 8.6 that we got here, 12 months divided by 8.6, that was about 1.39. Don't know where my math went wrong there the first time around, so I apologize. 1.39, so that's how many months, which is roughly 42 days. One month would be about 30 days, so another 0.4, a little more than 10 days, 12 days. 33% of a month would be 10 days, so we're at a little bit higher than that by a day or two. So we get to the same percentage there. All right, so we continue here. So 1.39 times 30, yeah, so 41.7. So right, same ballpark. Next, we go look and measure our ability to pay our long-term debt. So we have our debt ratio and our times interest earned ratio. So our debt ratio is our total liabilities divided by our total assets. It shows the portion of assets financed with debt. So how much of those assets did we pay for originally with some sort of debt? So a debt ratio of 1 indicates that all assets are financed with debt. The higher debt ratio, the higher the risk. Obviously, if you think about if you paid for your car in cash and you paid for your home in cash, you have no debt. So you have some risk, right? If all of a sudden you need to have other bills and you have no cash available, as opposed to if you 100% financed your car and you 100% financed your house, suddenly if you can't make those bill payments, you don't have a lot of equity built up anywhere to refinance or potentially leverage those assets into helping you if you have some troubled times. It's the same way with business. If all their assets are financed, everything's mortgaged, if something goes sideways and they can't pay those bills, they have some bigger issues on their hand. Whereas if that number is lower, they have some flexibility, they have some equity built up, they have some ability to maneuver things around if they need to. So we can see here our supermarkets ratio, supermarts debt ratio is 0.55 and 0.5. So they got some freedom. They got some ability to make some moves if they need to. Not all their assets were acquired simply through debt. Some of it was from equity from the business, and some was maybe from the initial investment from the shareholders. The next formula, next ratio, the times interest earned ratio. So times interest earned ratio equals income from operations divided by interest expense. So it measures the number of times operating income can cover the interest expense of the business. So higher ratios indicate ease in paying interest expense. So for 17, for our supermarket company, we had 5.05, and then for 16, we had 4.07. That's basically telling us that we could pay our interest 5 times over again in 2017 based off of our operating income. So we have a lot of flexibility there we're earning enough money to pay off our debts. The lower the money, the lower that ratio. So if our operating income was only 25,000 compared to our 20,000 of interest expense, we'd be at like 1.25. It'd be a lot harder for us to justify that amount of debt because we're only just barely paying off the interest expense with the amount of money we're operating, without the amount of money we're earning. So it tells you that for both years, even though we had a significant jump up as we saw in our income statement, we're still comfortable in paying our current level of interest. Therefore we're probably comfortable with the amount of debt, which is all working together. If we go back to our last slide, while we have a good amount of debt, still not kind of towards that one where all of our assets are financed. We're at about 50%, 0.55, 0.5. So, we're in a comfortable level there. And we can see as we get to our interest ratio, we're clearly able to pay that interest based off of the level of income we are earning. So next we have measuring our profitability. So we got a bunch here: gross profit percentage, operating income percentage, rate of return on net sales, rate of return on net assets, rate of return on stockholders' equity, and then earnings per share of common stockholder. So our gross profit percentage, just like we had with our contribution margin percentage, it's our gross profit divided by our net sales. The gross profit, just like with our contribution margin, was our sales revenue minus our cost of goods sold. And here it tells us what fraction of each sales dollar that is gross profit and or markup over cost. So what basically, for every dollar of sales, how much of it went for the product or the service that we just provided to our customer, and how much of it goes to goes towards the markup or how much profit we made on an individual item. Obviously, before we get to our operating expenses, but just kind of the difference between the buying and the selling of an individual item in inventory or a service. So here, 17, we had a gross profit of 40%, and then 16, we had a gross profit of about 36.6%. So maybe it was a change in the items we were selling. Maybe we got some better prices because we were buying more, because we were selling more. But an increase in our gross profit. If you were looking at this company and you were analyzing it, you'd want to know what happened. How come? It's one thing for we sold more, so our net income or our gross profit number is higher. But when our percentages start changing, and you might want to do a trend, you might do a trend analysis. You never just want to kind of look at 1 year to the next year. You want to look at a kind of a couple years over time, because 1 year you might have some funky fluctuations, but if you get a trend, which is why we do those base year analysis, if the trend is like 37% and we're at 36 and 40, we're right in line. But if the base year, kind of the normal, is a gross profit of about 34%, where 16 we're already high, and then we're significantly higher in 17, it might raise some questions, might raise some red flags. Not necessarily a bad thing. Maybe it's just what's changing in our operations that we're getting this significantly increased gross profit percentage. Or on the flip side, if we're below it, why are we losing our gross profit percentage? Our operating income percentage simply is our operating income divided by our net sales. And again, all of these ratios are just trying to get it down to the very basics. How much of every additional dollar of sales is going to the bottom line of the business? So we have here for 17, and I should say it goes to the bottom line of the operations of the business. It's not net operating, it's not net income, it's just the operating income. So before interest expense, before taxes, etc. So this reflects the pricing decisions and the efficiency in controlling expenses, right? For the most part, a company can control how much they're selling their products for, and they can control most of the expenses they're paying. They have less control over interest. If they need to borrow money, they're kind of at the mercy of the banks. And the taxes, the rates are set by the government. So this is measuring their decision making for pricing and their ability to control their expenses. Rate of return on net sales. So that's our net income. So that's basically our bottom line. This is what I was talking about, jumping ahead a slide there. This is our bottom line, net income divided by net sales. So again, it's the percentage of each sales dollar earned that flows to the bottom line. The higher the rate of return on sales, the better. So 5.6% compared to 3.2%. for every dollar we're selling, we're making more money that goes to the hands of the owners, the net income of the business. Rate of return on total assets. That's our net income plus interest expense divided by average total assets. And this measures the excess of using the assets to earn profit. So the investments we're making in our assets, whether it's inventory, accounts receivable, probably more likely it's going to be our investments in our property, plant, and equipment. How well are we using those investments to turn into a profit? So the higher the rate of return, the better. So we had our return on total assets, our calculation here. So we take our net income plus our interest expense, add that back. So that'd be 68,000 as our numerator, and then divide it by our average assets. So 644 for 16, 787 for 2017, divided by 2. So we have a 9.5%. So basically, for every dollar we spend on an asset, 9 cents is going to go right to the bottom line. So obviously, the higher the number, the better return we're getting. So again, you would want to look at the baseline for this for year over year to see how efficiently and how effectively we're using our assets. The rate of return on common stockholders' equity. So it's our net income minus any preferred dividends. So that's if we have two different classes of stock. And that's going to be divided by our common stockholders' equity. So it shows the relationship between net income and common stockholders' equity. How much income is expected to be earned for each dollar invested by the common stock shareholders. So for our supermarts, we had no preferred dividends. So it's just our 48,000 divided by our average common stockholders' equity. So it's 320 divided by plus 356 divided by 2. So that's about a 14.2%. So for every dollar that the common stockholders invest in the business for this time period, about 14 cents is returned to them in the form of net income. Earnings per share, again, it's our net income minus our preferred stock divided by the number of shares of common stock outstanding. So our outstanding stock, just so you know, and again, if you're not an accounting major, you're probably not going to see a lot of these terms again. And these might just be ratios calculated when you're looking at the company or looking at investments. But our outstanding stock is our issued stock minus any treasury stock. And all treasury stock is if I issue stock, but then as a company I buy it back later from our investments, from our shareholders. So this must appear on the income statement for publicly traded companies. The amount of net income earned for each share of company's outstanding common stock. So we're going to assume no preferred stock or dividends and 10,000 shares outstanding. So for this one, we had $48,000 of income for 2017, $26,000 of income for 2016, and then divided by the 10,000 shares for each year respectively. So for 17, every shareholder, basically every one shareholder gets $4.8 earnings. If the company liquidated, obviously in real life, if a company makes money, the shareholders don't directly get every dollar split up. Some of it's retained by the business, so on and so forth. But we can see there that if, kind of extreme worst case scenario, or if the company was liquidating, that would be their portion of the income, $4.08 per share compared to $2.06 per share. So for this, the investment the company is making in itself by buying those additional assets, even though it's through financing, what they're doing right now is paying off, and the shareholders are in theory getting wealthier and wealthier because the earnings per shares, eventually at the end of the day, the shareholders are one that reap the benefits of the business doing better. Their shares are worth more than they were the year before as the earnings per share have increased. So lastly, we're going to analyze some stock investments. So we have our price earnings ratio, so PE ratio. That's the market price per share divided by earnings per share. So it shows the market price of $1 of earnings. So assume the market price for the supermarket stock was $60 at the end of 2017 and $35 at the end of 2016. Sorry about the chime there. We got an email. So we'll continue. So for 2017, we had $60 to earn. We had to pay $60 to buy the stock to earn $4.08 per share. So the PE ratio was $12.50. So we had to spend $12.50 to get a rate of return of $1. of earnings. And then for 2016, it was $35 per share with the earnings per share of $2.06. So basically for every dollar of earnings, we had to spend 13.5. So even though the stock price went up, it cost us less money to earn $1 of earnings from that stock. So this, when you start getting into, and this is one of those where if you start getting into buying stocks on the market, the PE earning ratio, that tells you how much really you're paying for $1 of earnings. So even though a stock may be priced at $60,000, like if you think about Amazon, I think the stock price is like $1,200 or $1,100, some stupid amount of money. And if it's going up and up and up, but it's a good stock, a great stock. But if you compare that to a lower price stock and you look at their PE ratio, it might be actually cheaper. Either that, Amazon and Apple, those stocks are going crazy. It might actually be cheaper to buy another stock to get that return, to get that earnings of $1. So the PE ratio is a great one to look at. Your dividend yield measures the percentage of the stock's market value that is returned annually in dividends. So this is another one when you're looking at these last couple ones are good if you're looking at investing in a company. So what percentage of the earnings of the stock value is returned to you annually in dividends, right? That's from an investor standpoint. Yes, you can have the gains of the value of the stock, but the dividends is basically how much cash is going to get returned to you every year. So if a company is doing great, but they never give out any dividends, you're never going to see any cash from that investment until you eventually sell that investment. So a lot of growing companies will not necessarily be paying out dividends because they're going to be returning those earnings and that increase in value to reinvest in the business. More mature stocks, companies like Johnson & Johnson or Lowe's or Home Depot or even Apple now, that they've already established, here's their business, and they're kind of now just churning and they're not making as much, or they have enough capital on hand to continue to invest without relying on year-to-year operations. They might start paying out dividends. So this is a good one to look at when you're looking at if you want to have a mix of investments where some are companies that are growing at value, think Amazon, and then you have some other companies that are kind of steady. They're not going to have those fun and exciting big swings in the business, but they're just going to steadily be providing you some streams of income. The dividend yield percentage is a good one to look at. So for our company here, we're going to assume we paid cash dividends of 1.2 in 2017 and $1 in 2016. Again, our market prices were 60 and 35. So 1.2 divided by $60 of the market value. So we're going to get about a 2% dividend, or 2% of the market value will get returned to us. Whereas in 2016, even though the value was $35, we still got $1 dividend per share. So we actually got a higher dividend yield, 2.9%, which, if we think about it, the company was made some significant improvements, significant investments in itself. So maybe it just didn't have the same amount of cash freed up to pay out the dividends. So this isn't telling you it's a good investment or a bad investment. It's just telling you, yes, we're going to make more money because our stock value is going up, but we're not going to see as much as a percentage. We're not going to see as much as a return on our dividends. So this is kind of really the whole, this dividend yield is really a good example of where getting it into a percentage tells you a better story. If you just look at the whole dollars, right, $1.20 versus $1, you would just think, oh, 17's better, we're making more money, we're getting a better dividend. But when you look at the percentage of the market value, we're actually getting a lower percentage return on our dividends, which, again, not a good thing or a bad thing, because if you owned the stock in 16, now that it's worth 60, you have a better, more valuable asset. You're just not getting that return right away. You'd have to sell it to see that return on the investment, whereas your dividend would be getting it in real time. Lastly, we have our book value per share of common stock. And, this is just telling you what's the book value of the business divided by the number of shareholders. So it's the total stockholders' equity minus any preferred equity divided by the number of shares of common stock outstanding. So for 17, the book value has gone up, same amount of shareholders. So our book value per share of common stock is increasing with the increasing value, the book value of the company. One of the things you must want to keep in mind with this one is the balance sheet is recorded at historical costs, what you paid for your assets. If you have some significant appreciation in the value, right? If anyone here has bought a house or their parents have bought a house, They might have paid for it back in the 70s or 80s or 90s. They might have paid a lower amount, and it's worth more today. So the market value is higher. So that's just kind of how misleading things whenever you look at the book value of a balance sheet. If they have a building on the books from the 50s that was on the books for $10,000, today it'd be worth $1 million or something like that. So it is a little bit misleading, but just here's the book value, and we're going to slice it up amongst all of our owners. So some of the red flags in the financial statement analysis, so movement of sales inventory of accounts receivable. Again, if we see the ratios are off, if we see sales increasing, but the inventory turnover is down, the receivable turnovers are down, those are things you don't want to see. Yes, we're selling more, but it's causing us to not turn into cash quicker. Decreased cash flow, earnings problems, too much debt, inability to collect receivables or build up of inventory. So if we see anything there, those are all red flags that are going to be uncovered with, the slides we just covered, 15, 20 ratios, maybe about, an hour's worth of work to kind of map all those things out in a particular 2 years if you have them. And they can really uncover a lot of problems. And when you're looking at companies, they might show some red flags of, hey, what's going on here? Yes, our sales are increasing and our net income's increasing, but why aren't we turning anything into cash? Why does our bank account have, $15,000 less dollars than it had at the end of last year? Some sustainability and financial, I'm just going to skip through that. So there's the end of chapter 14. So, I think this is a really, really fun chapter. It's a really, really good chapter to understand, because you can take away these skills and use them in your own personal life if you're doing some investing, or if you end up trying to start your own business. You can actually do your own analysis to see where you're going. And you can also do this analysis so that way if you're ever trying to raise capital, you can understand what the people who are looking to invest in your company would be looking at. So that's the end of the chapter. Hope you enjoyed it. This week we had a couple things to do, so make sure you check my courses, and we'll see you later. All right, thanks, bye.